Welcome to Daily Rates Live with the Mortgage Calculator. Today we're going to go through some live mortgage rates and then do a deep dive into asset utilization loans. So, great topic here for today. We're going to wait just a minute here to get started. Let us go live on all the different platforms. As you tune in, feel free to drop a comment there. We have the chat pulled up on the screen. I see some comments already coming in there. Appreciate you tuning in nice and early. Just give us 1 minute here to get started. Hope everybody is having a great week. We got a great topic for today. Excited to get into it here momentarily. And as you tune in, keep dropping comments there. Thank you for the comments, Owen, Ashley, Jason, Michael. Appreciate it. All right, it looks like we are good to go, so we'll go ahead and get started. Feel free to keep dropping comments there in the chat as you tune in, and also drop any questions you have about our deep dive topic as we go through here today. Welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. Now, we do this show every weekday at 11 a.m. Eastern, where we go through the different live mortgage rates for the day, and then we do a deep dive into a different loan topic. Today's topic is something we're very familiar with here at the Mortgage Calculator because we do specialize in non-QM loans, which is an asset utilization loan or asset depletion, I guess it's also called, which I'm sure Jose will go over here shortly. So our sales manager, Jose, with 28 years of experience, is going to do a deep dive into asset utilization loans. But before we do that, we're going to do what we do every morning, which is pull up the live mortgage rates for some different programs and go through them. So Nick, if you're ready, let's go ahead and pull up our pricing tool and we will see what the rates are looking like this morning. Always interesting in these times, these days and times, to see what the rates are looking like.
All right, let me switch my screen and we'll check it out. So as Kyle mentioned, this is our pricing tool. This will have the general rates and APR for today. It is October 12th, just after 11 a.m. So we'll see what the basic programs have with the new rate sheets today. Definitely had some downward momentum the last couple of days. Looks like the markets have stabilized here a little bit. But we'll go ahead and set up a scenario we can compare across all the different programs. So we'll set up a $400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment for all the demos. We'll set the desired price here to show us the lowest rate option we can have. And we'll compare our conforming conventional options with FHA. And then we'll check out our expanded guidelines, also known as non-QM, where we have over 5,000 additional programs, including the topic for today, the asset utilization programs. We also have VA and USDA. VA is only for eligible vets and active service members. If you are eligible, we can quote that, no problem. And USDA is only for eligible properties. So if you do happen to be shopping in one of those areas, just let us know. But since not everybody is eligible for either of those, we don't do those live. We'll start with conforming conventional. We'll do purchase, 30-year fixed loan, standard loan, primary occupancy, single family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated credit score of 760 and an estimated debt to income ratio of 40%. So with these settings, let's check out the lowest conventional options today. Not much different than yesterday. So again, it kind of stabilized a little bit here. Definitely better than the last couple weeks, which is great. 7.125 rate, 2.5 discount points. So this is the lowest rate really option that we have. And the APR 7.342 there. So a great option for our customers looking for conventional. It's definitely lower than it has been the last couple weeks. Definitely take advantage if you've been shopping out there. Now, if our customer doesn't qualify for conforming conventional programs, typically the next option we want to look at is an FHA program. So we'll set up the same exact scenario. And this time we'll compare FHA. FHA does allow a little more leniency in credit events, as well as a much higher debt to income ratio. So typically our customer that may not qualify for conventional, will typically have a easier time qualifying for FHA. So we'll keep everything else exactly the same, even though the DTI can be higher. We'll keep it the same so we can compare APRs across the program. So let's check the lowest rate options for FHA today. All right, again, about the same as it was yesterday, 6.375 rate, 2.311 discount points and cost, puts the final APR at 7.012 for FHA, which is just a touch under conventional today. So as it has been for the last recent while here, definitely recommend our customers that qualify for both conventional and FHA. FHA may actually be cheaper in this case, even though it does require the mortgage insurance both upfront and yearly, which is included in the APR there. Now, if for any reason our customer doesn't qualify for either conventional or FHA, many other banks or lenders have to deny that customer, but that's where we love to help out with our non-QM programs. So we'll set up the same exact scenario. This time we'll choose expanded guidelines, also known as non-QM, where we have over 5,000 additional programs beyond what the standard banks usually have. So when we select this option, we can now choose alternative income. So full doc is what we use for conventional and FHA. That's 2 years of tax returns. Typically choose non-QM to take advantage of one of these others. Asset related is what Jose is going to talk about here in a second. Business bank statements, also popular. We have investor only programs that only works for investment properties. Personal bank statement, 12-month. That's the most popular program by far. That's what we use for our demo. We also have RSU, stated income, BOE, 1099, P&L, no income. We went over a few of these this week as well, so check out those past episodes. But for the live pricing, we always do 12-month personal bank statement, which is our most popular program for our self-employed borrowers. Many times it's our self-employed borrowers, when they submit tax returns, may not qualify at all, or just may not quite get enough income to get the home they really desire. So we'll solve that problem by using no tax returns at all. Simply use their last 12 bank statements to determine a debt-to-income ratio of 40% using just the cash in the bank. So typically our self-employed borrowers qualify with double or triple the income using this method. So let's check out the non-QM options this morning. And we have the one specialty portfolio option, 7.25 rate, 2.5 discount points and cost, 7.367, right there with conventional, almost identical. And then we have the more traditional bank statements as you scroll down, which may allow a little more leniency on other issues, such as credit events, foreclosures, bankruptcies, things like that. So tons of different options here, dozens, if not hundreds of different variations of bank statement options. Please get with our team and we'll find the one that fits best for you. And before we go into Jose's asset-related options, we will do some live pricing for investments. So for the lowest rate for investment, we can go a little bit lower, and we'll compare our conforming conventional options with our expanded guidelines, also known as non-QM. Remember, government programs do not work for investments, so no FHA, VA, or USDA applicable. So we'll start with conforming conventional. Everything's going to stay the same. All we've changed here is the occupancy to investment. So let's check out the lowest options for investment. So this is where our specialty programs really kick in. So that same specialty portfolio program is not technically conventional, but it uses the same guidelines here. Because there's no loan level price adjustments, which has pushed the conventional programs really high. So you can really see the difference here. So we have a portfolio program with no adjustments for 7.125 rate, 3.5 discount points and cost, puts the final APR at 7.375. Or we have the conventional program with the conventional adjustments here, which pushes it up to 7.75 rate, 3.5 discount points and cost, and pushes the final APR up to 8. Definitely recommend anybody out there check out these portfolio options that are popping up if our borrower is looking for conventional and can get these new portfolio options that have the reduced loan level price adjustments. Now, let's do our final demo here for investment properties and compare our non-QM options. So this time we'll select expanded guidelines, also known as non-QM. Everything else will stay the same, but now we can choose our non-QM income type, which for investment properties, the investment type of income is DSCR. That's the most popular one because it doesn't require any income or employment from our borrower. Simply use the estimated rents from the property to determine a DSCR ratio. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage, the expenses, and the property cash flows monthly, that's a ratio of 1.0 or higher. If the property does not cash flow monthly, that's a ratio of under 1. We still have options for that. For the demo, we always put the highest value, 1.5, so we can see all the programs pop up. And the final thing is prepayment penalty. 3 years is standard. We can select 0 if we wish. That will limit what shows up and cost more. We could also select 5 years if we wish. That will limit what shows up, but save our borrowers some money. The standard option is 3 years, so that's what we use for our demo. So the most standard options pop up. So let's check out the DSCR options today. So beating conventional, not quite beating our portfolio special, but beating regular conventional by a long shot here with this DSCR, 7.5 rate, 3.475 discount points and cost, puts the final APR 7.649. Amazing. And this option even beats most of the conventional options we saw as well. 7.875, 2.975 discount points for a final APR of 8.008. So right now we have a couple options beating conventional, which is amazing. Most of our investors that compare a DSCR to a conventional will choose a DSCR even if it's way more expensive. And when they're the same price, I'd say 99+% of investors will choose one of these DSCR options, especially considering today they're actually cheaper, which is absolutely amazing. So definitely recommend everybody out there that is an investor, check out the DSCR options. Tons of flexibility. You can do 1, 2, 5, 10 of these loans. No personal income needed. Cash out multiple properties, purchase multiple properties. And as we scroll down here, some of these at higher rates and costs may allow bankruptcies, foreclosures, other issues, and may allow short-term rental income. Very popular request. So tons of different options here. Please get with our team on the best one for you. Now let me change my screen again here. And we'll get into today's topic, which this week we've been working on non-QM loan options. So asset utilization, as everybody sees in the demos, there is a button there on the pricing tool for asset. It is a little bit specific, so that's why we want to do a deep dive into that. So we don't do that on the live pricer. It's a little bit specific with specific guidelines. So Jose is going to pull up some examples of different ways. As Kyle explained, there's kind of 2 different ways to categorize these programs: asset utilization, asset depletion, different ways to calculate the income. Every program has a different method to calculate. So Jose has some specifics here, hopefully that are pretty standard. But remember, every time you pull up one of these programs, there's going to be a slight variation. Some will use 240, some will use 60, some will use 84 as their factor. So lots of different variations within this. That's why it's hard to do on the live pricing. So hopefully Jose can help explain this a little better for everybody. We love these programs. They're very flexible. Just know that they do vary quite a bit program by program. So Jose, if you're ready, let's go into your specific examples today so we can check out the asset programs.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you this morning. Previously, or should I say in the not so distant past, the asset utilization loans were really only available through your big brokerage houses. You'd have a large trading account there, a lot of money in there, and they would let you borrow and with your assets pledged, right? So that's a different type of situation than what we're talking about now, because in our asset utilization option, you don't have to pledge any assets. They're not tied up. There's no margin calls or anything like that, which can get pretty risky if you are using your assets as collateral, something other than the actual real estate as collateral for the loan. our asset utilization or asset depletion option loans only use liquid assets to qualify the borrower. The income is calculated, as Nick mentioned, depending on which conduit you use for the loan. They're all going to have different guidelines and most likely will have different formulas to calculate the income, right? It's usually going to be based on a percentage of the funds in the accounts that are being used. For some accounts, they let you use 100%. Other accounts, less than 100%. Less than 100%. Like, for example, if you have a 401k account, retirement account, that's going to have some type of a restriction on withdrawing the funds, or it could be penalties of the sort. So those accounts usually will not be counted towards your asset for the income calculation at 100%. There will be an adjustment. So you do have to be aware that not every option is going to be the same. As a matter of fact, they're very different. So you really have to look deep, size up the situation that you have with your borrower, and pick the best option for them. In most cases, it's not really going to revolve around the rate as much as the formula to calculate the income, so you can maximize the income used to qualify the borrower. Now, this program is not dependent, as you would imagine, on any type of employment. It's not dependent on whether it's primary, second home, or primary. It's simply going to use the assets. Now, obviously, whether it's primary, second home, investment, property type, all those things will come into play as far as interest rates and loan to value and whatnot. But those factors are not taken into consideration when calculating the actual income, right? Strictly the assets that are applicable for this loan. So this is a very good option. For example, high net worth individuals that may not want to disclose, for whatever personal reason they may have, their tax returns, especially maybe their business tax returns. Maybe they may be concerned that confidential trade secrets will be disclosed somehow. So, it's their prerogative to say, hey, I have the assets. I'd rather go through this asset utilization program than have to disclose my tax returns or any other personal income or personal information of that sort. So very good option, as long as they're willing to accept a little bit higher rate than what you would normally find for a full doc program. Then the only thing that's going to limit is how much they have in liquid assets. So with that being said, make sure that you don't consider anything like other assets, like, let's say, artwork, expensive artwork that they have sitting that they show you an appraisal for, fancy paid off cars, gold bullions, or anything like that. Now, if they have a gold-backed IRA, for example, that's a different story, right? That account has statements, has a dollar value, and it can be cashed in for whatever the value is, less whatever they deduct for cashing in the retirement account. So that's a different kind of situation. So let's get into our examples here. Maximum loan to value is 90% for primary purchase and 85% for investment purchase. Maximum loan to value for a cash out refi is 80%. So this example here, we have a 1-unit primary purchase and also no mortgage insurance applicable ever for non-QM loans. So here, this example, we have lowest cost option 11%, lowest rate option 10% for our 1-unit asset utilization. Now, for our house hackers out there, here's our 2 to 4 unit option, same loan. And you will also notice, like as is the case in most, I'm not going to say all, but in most cases, there is no difference between the 1-unit and the 2 to 4 unit on non-QM. However, on DSCRs, as you all know, the 85% LTV DSCR option is only for 1-unit properties. I wanted to say that so nobody's confused. Investment asset utilization, 1 unit, max 85% LTV. You're looking at 11.874 is our lowest cost option. That's our par rate. And you can buy that down all the way to 9.124. So that's a nice deep rate sheet there with many options. And again, this is for our investment. Investment 1 unit. And here is investment 2 to 4 unit. Again, 85%. And no loan level price adjustments for the 2 to 4 units. So again, 1 to 4 units in this product, in this option that we're looking at. Same pricing, same loan to value. And now cash out options here. I did mention maximum LTV on any cash out option, whether it be primary or investment for this option, is 80%. But you will note, even though this is a cash out option, once we drop down to 80%, which again is a more standard loan to value in the non-QM world, now our rate is much better. We're looking at 9% at par, and you can buy that down all the way to 7.75%. So those are amazing rates for considering we're using your assets to qualify you. We're not even asking you to pledge your assets. We're not asking you to park them in an account indefinitely. You can show them and then use them after closing. Again, our primary cash out option for 2 to 4 units, same rate, same cost. 9% is at par. 7.75 is your lowest rate option. And now asset utilization for investment, again, 80% cash out. Look at these rates. 8.99 has a little bit of a cost. And again, you can buy it down 7.75 with roughly 3/4 of a point more expensive than the primary 1 unit option was. That's the only adjustment there. And then our ultimate house hack is, the investment 2 to 4 unit. This one now going investment is a little bit different than the primary, but still good rates at 80% LTV. Remember, this is 80% LTV investment, 2 to 4 unit cash out, and we're still 80% LTV, which is a very high LTV, not attainable in the conventional world. You're looking at 10.874 as your lowest cost option and 8.749 as your lowest rate option. So great options for our asset utilization or asset depletion borrower.
All right. I don't see any questions here, but just for the more simple people like me, basically what you're saying, Jose, if somebody has a lot of assets, they can get a loan against it, don't have to pledge it. They have a large amount of money or a large 401k, then we're going to lend based on that, right?
Absolutely. Keep in mind, for example, retirees, right? Let's say they may have Social Security, $1,500, $2,000 a month, but they may have $1 or $2 million in a 401k. That's a perfect use of an asset utilization loan. And in that loan, you could, we have options where you could use the asset, and you could also use the W-2 income or their Social Security income as well, if it's going to help them qualify for any amount extra.
But you're saying no income verification and no job verification necessary.
On the asset portion, yes. If you're going strict asset utilization, no, exactly. Just verifying the assets. Now, there is some seasoning requirement on these assets. That's
what I was going to ask you.
That is going to depend on the conduit path chosen for the loan, right? Your guidelines. But some will say you got to have them to remember one, for example, you have to have at least 4 months. In other words, the account has to be at least 4 months old. It can't just be like a brand new account you just opened up 2 weeks ago, and then use that to qualify for asset utilization. So besides the percentage of the asset that's being used, besides how many months they're going to have you divide whatever amount of the asset they let you use, also be aware that the asset does have to have a certain amount of seasoning, or in this case, seasoning would be age of the account that has been opened.
Okay, great. All right. Well, thank you everybody for tuning in. Remember, we do this 11 a.m. Eastern every single weekday where we go through the live rates and then we do a deep dive into a different topic. So we'll be back tomorrow with a new topic. We appreciate everybody tuning in. Thank you, Nick. Thank you, Jose. We'll see you tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody. Have a great day.